Hello everyone. In this video we are going to learn about the corporate governance and social responsibilities. The whole chapter covers this portion of the syllabus. However, in this video we are going to cover the principles of corporate governance. So basically, what is corporate governance? The main definition of corporate governance is that it is basically the best practice to run a business. Corporate governance is the best practices to run a business, the best practices implied in a business to run its operations. What are they for? Why have they been improvised? Are they principle based or rules based? So we are going to learn all these things. So what is corporate governance? Is the system by which organizations are directed and controlled by senior officers. Most countries adopt a principles-based approach to corporate governance, meaning that the best practice guidelines are set out for the companies to follow. There is a difference between a principles-based approach and a rule-based approach. What is the major difference between the two? Principles are usually implied set of guidelines that the companies do follow for the best running of their operations. However, rules are the ones that are must to be followed. Why? Because they are usually imposed by the government as a must follow. For example, there may be a rule regarding that the company should employ, for example, a minimum of 20 trainees per year who are the new graduates from different universities. It's a rule. The company must follow this rule, otherwise they will be charged with the penalties or expenses or other sort of things, whatever. We are not going into that detail at the moment. However, the principles must be or might be that they should appoint directors from different sectors to have multiple industry experience. Now this is not a rule, it's a principle which a company can follow. It's not a rule that must be followed, but the company can follow in order to get an advantage of very industrial experience. So there's a difference between principles and rules based approach. However, certain big companies, usually listed companies who are being traded at different stock exchanges, do have to follow a rule-based approach by the company that the country usually have imposed for them to follow certain corporate governance codes that they have to follow because they're very huge and they do have a vast set of stakeholders, and therefore to cover their interests, certain countries have imposed certain rules in the name of corporate governance to be followed by the listed ones. The others do not have to follow them as a rule, but however there are principles and guidelines to be followed as the best practices. And who are the people who have to impose or implement these rules? They are usually the management who is running the operations, who have to make sure that these are all implemented, because the managers are usually working on the agency concept. That means that for a client, manager is acting as an agent of the company. This is the basic crux of the agency concept. We'll cover it later. So to continue, there are a number of elements in corporate governance which are to be covered. Reduction of risk, because you can go for independent directors who will not only be looking after their own interests only, because they will be independent and not running out the operation. So there would not be any familiarity threat or self-interest threat, self-review threat. So therefore they will be looking after the operations more independently, and therefore reduction of risk will take place because of their independence. Overall performance would be enhanced due to independence of directors. Plus there is a rule in corporate governance, like the chairman and the board CEO must not be the same person, because CEO is the one who's running the show. However, chairman of the board is the one who has to take certain decisions, and many transactions are to be approved by the board. So the both person should not be the same. CEO should be accountable to the board, and overall performance would be enhanced because of accountability of the person running the show in front of the board. Framework overall, because it demands, we'll cover all those things later in detail, that the framework means the overall governing bodies of a company, which includes different committees under there who are reporting under the board of directors. So this is the overall framework. Apply the spirit and accountability of all the workers and the senior managers will result in further improvement in the quality of work what is being observed. So what are the things that are a part of corporate governance to be implied at any cost? Integrity, which is basically ensuring the honesty with all the employees and customers and all the stakeholders. Accountability, business being answerable for its actions, and it all can be covered and ensured, or at least checked, if we implement all the corporate governance requirements or the advices or the guidelines. If we follow all the guidelines of the corporate governance, we can ensure the integrity and the accountability, because the directors are independent, the audit committee is independent of the operation of all the operations. Basically, one of the requirements is that the internal audit should be reporting to audit committee directly instead of the CEO who is running the show, because the audit committee's findings would be directly contradictory with the CEO's performance. So independence of directors, independent people working within the organization, checking if the business is complying with its code, and good management. Independence will be ensured if non-executive directors are looking after at certain reports in the board meetings, and therefore they would be able to give their independent opinion upon the running of the show. So what are the different perspectives on the governance of small businesses? Usually the perspective is different as compared to large business. Why? Because usually in the small businesses, shareholders and directors are usually the same people. Therefore, owners and the managers are the same. So the governance would be at same level. I would say that there would not be enough independence of reporting, because there is not that much requirement of independent reporting, since the managers are themselves the owners. So the owner will not cheat himself. Secondly, there is not too much public interest involved in a small business. So therefore, the regulations are also not that much strict on the small business. However, in contrast to this, when we look at the larger businesses, the shareholders will not be involved in their day-to-day running and management of the business. Therefore, the owners and the managers will not be the same. So there are many times there could be conflict of different interests. Usually, an example of this conflict of interest is usually the owner's perspective is usually maximization of profits. However, when the organization seeks to achieve the best practices and follow all the guidelines of Code of Corporate Governance, the organization needs to spend on it. therefore it would be against the owner's will. That means that if a manager is ensuring that all the CCG's requirements are being met, CCG means Corporate Governance Code of Corporate Governance. So if the managers are willing to achieve all the CCG's requirement that in some way would be against the owner's will, therefore could result in a conflict of interest. So what happens is, the agency concept that we discussed, I gave a hint of that earlier, comes into play. What is an agency concept? When applied to corporate governance, the agency concept means that the managers are acting as the agents of the company, whereas the owners are the principals. It is usually relevant only for the large organizations, because small organizations have managers as their owners and owners as their managers. So in the large organizations, there is a greater degree of separation between ownership and management, and that is why the agency concept comes into play in only large organizations, where the managers are acting as the agents of the company. And there is another theory of stewardship theory, which means that the managers, it views the managers as the stewards of the assets of the company. That means that the managers are the ones who are basically taking care of all the assets of the company in whatever way they are employed or deployed. So basically they are the managers who are ensuring the best use of all the assets to get a return out of them. So basically what happens in this approach is that it is very obvious that most of the power would be vested in these stewards. That means that executive managers. Now what does the agency theory suggests? It says that it is recognized that management are likely to pursue their own interest, which we discussed could result in a conflict of interest. Why? Because the owner's interests could be against what the management is trying to achieve as a requirement. In large companies, for example, we took an example of ensuring all the CCG requirements, meeting all its requirements. So therefore it is important that the manager's interests are usually aligned with the owner's and organization's goals. Only when these goals are aligned and consistent, the benefits will be floating towards the shareholders and other stakeholders. Only then it would be in the best interests of the company and its shareholders and its other stakeholders, because only then it would be possible that the company runs smoothly. Because otherwise, we have read it earlier that in case of conflict of interests, the managers could be asked to quit, or the owners could go for a wrong decision deliberately to fail a management's personnel in order to ensure its own power. So all of these will go in return against the best for the shareholders and other stakeholders. And what the stakeholder theory suggests, that the stakeholder, basically this theory is much more organic than the other ones, meaning that the company is in itself a separate legal personage. It's effectively the development of the notion of stewardship, that the management, basically it states that the management has a duty to cover the interest of and care for all the stakeholders, maximizing the shareholders' value, but also covering the wider community interest of the community and other stakeholders, their payments and all those things, not only looking after the owners. So basically this is the stakeholders theory. Now what are the principles of the CCG? What are the requirements that are addressed through applying the guidelines of CCG? Minimizing of risk because of accountability and independence, ensure adherence to and satisfaction to all the policies and their implementation, to fulfill responsibilities of all the stakeholders instead of only owners. All stakeholders' requirements shall be fulfilled in order to view as a larger picture, in order for the government to continue working, to be in a working relationship with all the people, to ensure the security of all the people working with the organizations, and to keep their business going. It is a requirement to fulfill responsibilities of all the stakeholders, including its employees, its customers, its banks, its suppliers, etc. Establish a clear accountability. This can be achieved through different independent directors, different committees, independent audit committee, etc. To provide accurate and timely reporting, so that the investors can make their decisions timely, and further the management can also make the right decision timely. If the reporting would not be accurate or will not be timely reported, the decisions may go wrong. An example would be, for example, in these days, if you are not aware of the coronavirus's implications in different economies, and you're preparing a complete order for in anticipation of an export to certain other countries, then it will become a very huge problem for that company, because it will be investing in its stocks, whereas it will not be able to export them because of this virus. To encourage more proactive involvement of the personnel, the management, and to promote integrity. Principles versus rules. We have a continuing debate on the corporate governance, whether they should be in the form of principles or rules. I told you the difference between the principle and rules earlier, that the rules are the ones which are implied by the government and must be followed, and whereas the principles are different. Rules are the form of detailed laws and regulations, whereas principles are a set of guidelines to be followed. So there is a consistent debate upon this. However, what actually is happening is that the certain listed companies are following, listed companies and large companies are following the rules. However, the other companies do follow principles in contrast of the rules, and they have a little bit relaxed approach with respect to the CCG's requirement fulfillment. Basically because of the scale of the company, because of the stakeholders that on effect, the government doesn't impose them to follow all the regulations, because they are not a wide range of stakeholders as with the huge companies. And I think this is it for the basic principles of corporate governance. In the next video, we will cover the new developments that have been taking place in the corporate governance section. Till then, take care. Goodbye.